This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets. Russia is sending more crude oil produced in the Arctic region to China and India, and at steeper discounts, after Europe slammed its doors shut on Russian supplies last month, trade sources and data show. Arctic grades Arco, Novi Port and Varandi do not normally head east but are now finding new homes further afield after the European Union, G7 nations and Australia introduced a price cap on Russian oil in December, on top of an EU embargo on Russian crude by sea. Sellers are selling the Russian crudes at bigger discounts as they absorb higher shipping costs. All these Arctic crudes usually go to the EU but now they have to go elsewhere, a Singapore-based trader said.
China's liquefied natural gas, LNG, demand is forecast to recover in 2023 as the country emerges from COVID-19 controls to become the bright spot in Asia's consumption for the super-chilled fuel. China's demand is set to rebound to between 70 million and 72 million tons in 2023, 9% to 14% higher than in 2022, say analysts at Rystad Energy, Wood Mackenzie and ICIS. But imports to China, which has the world's second-largest economy, would likely fall short of record 2021 levels, because prices would stay high and lingering effects of the pandemic would limit appetite, they added.
Moving on to the top news in the energy sector.
Oil prices rebounded on Thursday amid dollar weakness and as investors emerged to buy dips after two sessions of steep losses, though economic concerns capped recovery. Brent crude futures had climbed 89 cents, or 1.1%, to $78.73 a barrel by 0740 GMT, while U.S. West Texas Intermediate crude futures rose 87 cents, or 1.2%, to $73.71 a barrel. Big declines in the previous 2 days were driven by worries about a potential global recession, especially since short-term economic signs in the world's two biggest oil consumers, the United States and China, appeared shaky.
OPEC oil output rose in December, a Reuters survey found on Wednesday, despite an agreement by the wider OPEC Plus alliance to cut production targets to support the market. The Organization of the Petroleum Exporting Countries, OPEC, pumped 29.0 million barrels per day, BPD, last month, the survey found, up 120,000 barrels of oil per day from November. In September, OPEC output had been its highest since 2020. December's rise was led by recovering output in Nigeria, which has been battling for months with crude theft and insecurity in its oil-producing region.
Next, we have the top news in metal markets.
China's state planner has allowed 3 central government-backed utilities and its top steelmaker to resume coal imports from Australia, the first such move since Beijing imposed an unofficial ban on coal trade with Canberra in 2020. The partial easing of the coal import ban comes after the Australian and Chinese foreign ministers met last month seeking to reset the frosty diplomatic relations between the two nations. The National Development and Reform Commission, NDRC, summoned China Datang Corp, China Huaneng Group, China Energy Investment Corporation and China Baowu Steel Group on Tuesday to discuss the resumption of coal imports from Australia, two people familiar with the matter said.
Copper prices in Shanghai touched their lowest in 2 months on Thursday as rising COVID-19 cases in top consumer China stoked worries over demand that is already under pressure from weakening global industrial activity. The most traded February copper contract on the Shanghai Futures Exchange dropped as much as 1.8% to 63,850 yuan, $9,289.98 a ton, its lowest since November 4, 2022. It ended down 1.2% at 64,290 yuan a ton to log its 5th straight daily loss. SHFE nickel shed 5.2% to 220,290 yuan a ton. Aluminium fell 0.6% to 17,905 yuan a ton. Zinc decreased 0.7% to 23,170 yuan a ton and tin fell 1.3% to 207,380 yuan a ton. We will now look at the top news in the agricultural. Ukraine's efforts to increase exports under the Black Sea grain deal with Russia are currently focused on securing faster inspections of ships rather than including more ports in the initiative, a senior Ukrainian official said on Wednesday. Ukraine is a major global grain producer and exporter, but production and exports have fallen since Russia invaded the country last February and started blockading its seaports. 3 leading Ukrainian Black Sea ports in the Odessa region were unblocked in July under an initiative between Moscow and Kyiv brokered by the United Nations and Turkey. Under the deal, all ships are inspected by joint teams in the Bosphorus.
That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.